Hello there, everyone, and thank you so much for joining us today. I'm Sam, and I moderate these weekly presentations. In just a second, we're going to be joined by Tyson Mavar, our Senior Financial Advisor, and Ayako Yoshioko, Portfolio Consulting Director and Senior Investment Strategist at Wealth Enhancement Group, both of whom will be giving a really great in-depth analysis of how tariffs are currently impacting market trends, as well as how they could potentially impact your retirement planning. Just a couple items to go over quickly before they join us, though. One, you will see a QR code at the bottom of your screen throughout the presentation. You can click on that, or you can click down in the description box below to book a free 15-minute consultation with one of our financial advisors. You can also follow us here on YouTube, follow us on LinkedIn. We post tons of retirement-related content weekly, and we really think you'd get some value out of it if you considered giving us a follow. And lastly, I'd just like to remind you, we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here. So please keep that in mind as you're listening along. And with all of that out of the way, we're going to get started with Tyson and Ayako.
Good afternoon, folks. Thank you for attending our webinar series today. My name is Tyson Mavar. I'm a financial advisor with Wealth Enhancement Group. And recently, we've been hearing many questions and concerns from our clients and prospective clients surrounding tariffs. So today, we're going to talk about tariffs, the potential impact on consumer prices, as well as the relationship between inflation, interest rates, fixed income investments, and even retirement accounts for many of our clients that are preparing for or are already in retirement. I'm delighted today to be joined by my colleague Aya Yoshioka, who's a portfolio consulting director and senior investment strategist with Wealth Enhancement Group. Aya is regularly representing our company on networks such as CNBC and Fox Business. And I can't think of anybody more qualified to talk about this topic, at least within our company, than Aya. So without further ado, Aya Yoshioka. Hi, Aya.
Hi, Tyson. How are you doing?
I'm wonderful. And yourself?
I'm great. It's been a wild ride in market so far with all this news regarding tariffs.
Yeah, no doubt.
So, at least from our perspective, all of this headline news has definitely come with a little bit of angst from an investor standpoint. People are worried and they're seeing these big day-to-day swings in markets. And so are you getting clients giving you calls or questioning what they should do in these types of markets?
Phone calls, emails. I've scheduled a lot of meetings this week over concerns over whether it be inflation, the new administration, volatility in the markets, interest rates, a whole host of different topics. But yes, we have been pretty busy the last couple of weeks.
Yeah. Well, let's dive into some of those topics. So in terms of tariffs and what that could mean for inflation, I think that's been the biggest concern, right? The concern is that tariffs will increase prices on imported goods. And especially at 10 or 25% increases, consumers are tired of higher prices. There's an exhaustion level, I think, from a consumer standpoint. And so there's a lot of angst as to what this could mean for higher consumer prices and inflation going forward. There's one argument that says tariffs would just be a one-time price increase. There's another argument that says when it's a trade war, such as one that it's tit for tat and you get retaliation, that you're going to have to continue to increase those prices time and time again, which could lead to ever increasing higher consumer prices. So I think that's the bigger concern, is the latter, not the former. I think in 2016 and 2017, we saw in the first Trump administration, it was a little bit more of the former, one-time price increases, mostly with China, and it was a little bit more benign than I think investors feared back in 2017. Times are a little bit different now. There's a lot more at stake. And so I think a lot of clients are, a little concerned, and we are too, and we're monitoring portfolios and wondering when is the right time to make an adjustment? Should we make an adjustment? What are going to be the economic fallouts from all of these tariffs?
Yeah, and we've been hearing a lot of concerns because many of our clients were a bit surprised in 2022 when we saw inflation go up to a pretty large extent. And as a result, interest rates went up at the same time, which affected their fixed income side of their portfolio. So if you don't mind, can you talk just a little bit about the relationship between interest rates and fixed income investments?
Sure. So, when it comes to Fed policy or monetary policy, the Fed has two main jobs: price stability, or, making sure inflation doesn't get too out of control, and maximum employment. Those are the two pillars that the Fed is guided by. And so when it comes to inflation getting out of hand, especially in 2022, they had to increase interest rates in order to slow the economy down, right? Interest rates are sort of the fuel for the economy. It's the price at which money moves. And so having that higher makes money move a little bit slower. So when interest rates are higher, money moves slower and activity slows down, which can then slow down the rate of inflation. So now that we've sort of slowed it down, we're not seeing inflation at 9% rates. It's still a little sticky, right around 3%. And so the Fed has paused recently, and we may still get another interest rate cut, but interest rates are staying a little bit higher than we'd like it to be. And higher interest rates translates to different things, whether it be equities or fixed income. On the equity side, when you think about assets for the long term, when you have to discount that back at a higher interest rate, the current value goes lower, right? And it's the same thing for bonds. When you think about longer term bonds, those interest rates that you have to discount it back to, the current cash flow that you're receiving, it gets discounted back and the current value is lower. Additionally, with bonds, when interest rates are high on the short term, so current rates are higher than they were back in 2012 and 13 and even before COVID. But the bonds that were issued back then at those low interest rates don't look as attractive. And so if those bonds are still in people's portfolios, then those bond prices are actually going lower because you can get bonds with the same maturity at higher interest rates, which are a little bit more attractive. You want that coupon, you want that income. So that's the conundrum that I think many investors have to face when dealing with higher interest rates for the long term.
Yeah, that's a great point. And I work with a lot of retirees, as you know, and it becomes even more important to be very proactive at making sure the portfolio is allocated correctly, but also has the liquidity to produce income. Many of my clients can't just live off of the dividends and interest paid by their stocks and bonds. And when we have a rising interest rate environment and we see discounts to bond prices, now those either become an asset that lost value or an illiquid asset if we're wanting to hold those to maturity, which is not ideal for building a retirement portfolio. And what I'm talking to a lot of my clients now is considering alternatives to a traditional strategy of just having stocks and bonds in their retirement portfolio. And not just retirement portfolios, all portfolios, but especially on those portfolios that require liquidity and the production of cash flow.
No, I was just going to say on the alternative side, many alternatives are illiquid as well, but they are offering higher rates of return. And so you have to, have that conversation as well. But a lot of alternatives have become more liquid than they used to be. You used to not be able to access those funds for years. Some are now allowing for quarterly or monthly liquidity events. So you're able to access at least some of the capital when you need it.
Yeah, that's a great point. Thanks for adding that. We also have many of our clients, whether or not they understand it, if they have a pension plan, are severely impacted by interest rate changes depending on which type of pension plan that they have. And so the differentiation there is a defined benefit versus a defined contribution or cash balance plan. And many of my manager and executive employees of Fortune 100 companies, they'll have maybe close to half in some cases of their entire retirement portfolio tied up in these pension plans. The defined benefit plans actually have an inverse relationship with interest rates, wherein when interest rates go up, the lump sum value of their defined benefit pension is going to go down. And in 2022, the most recent example, when we saw interest rates rise really quickly, we had some clients and prospective clients losing 25, 30, in some cases 35% on their lump sum in about a year's time, which was very surprising to a lot of people. And many people weren't prepared for that. The defined contribution plans work a little bit differently, wherein typically there's going to be an interest rate credit. So higher interest rates benefit those plans as they start to grow a little faster. Oftentimes also the lump sum will be the default payout option, but they'll have an annuity payout option where the company will use interest rates and their life expectancy to convert that lump sum into an annuity. And the annuity actually goes up in a rising interest rate environment on the defined contribution or the cash balance plan. So they work very differently in terms of their relationship with interest rates. And every company observes these plans differently. Most companies today are using corporate bonds, short, intermediate, and long-term corporate bonds to calculate lump sums. But every company observes those rates differently and updates the rates that are used to calculate the lump sum at different frequencies. Some companies do it annually, some quarterly, some monthly. And this is why I think it pays to intimately understand your benefits, or at least work with an advisor that understands your company benefits. And if they don't necessarily have a lot of clients from your company, at least be willing to look at your summary plan description and very quickly identify what is this relationship and how can we set up the most effective and sustainable retirement plan as a function of the rules on your pension plan and all your benefits with your company. But if we do see higher inflation and as a result higher interest rates, we're expecting more losses to lump sums, and we'd like to help folks prepare for that.
And actions that clients might be able to take if we continue to see a Fed that, they may be cutting interest rates, but just at a slower pace?
Yeah, absolutely. That's one of the nice things about that slower pace is that it gives you time to prepare. One of the challenges, however, though, is if interest rates are slowly going up every quarter, and each quarter you're losing just a little bit of money on your lump sum and not enough to incentivize you to leave the company. Well, after a couple of years, now you may have lost several $100,000 because the changes weren't swift enough to encourage you to, whether it's retire or just leave that company that you might have worked for a couple decades, transition into maybe a part-time job or a consulting role, or maybe just go work for another company entirely for 5, 10, 15 years after your career at your primary company. So I think just the takeaway is that it's just good to run a plan and be aware of some of the variables that might have you changing your retirement plans. Unfortunately, retirement is a very stressful event psychologically, even for the people that are very financially prepared to do it. It's stressful to become financially independent when you've been used to getting a paycheck from a company for a long time. So the more time folks are willing to spend talking to an advisor or family members even about this inevitable transition into retirement, the less stressful it becomes psychologically, and the better people are prepared to make big financial decisions, oftentimes under duress when interest rates spike, or when there are cuts to employment within their company, or when some catalyst has them changing their retirement plan. The more time we spend on it, I've found the easier it is to make good long-term financial decisions for folks.
Absolutely. And I know sometimes it's difficult to control timing of retirement. And, we know that those people who retired in 2008 or 2009 faced a very different circumstance relative to maybe somebody who retired in 2024. And I think, one of the things that is new is the inflation component, right? The inflation component really is a conundrum for a lot of retirees as you start to operate on a more fixed income and a fixed income stream. You don't want that inflation component to eat away at that fixed income. So on one hand, you want higher interest rates to potentially generate a little bit more income out of your investment portfolio, but you don't necessarily want that higher interest rate to happen when you're retiring and taking that lump sum distribution, right?
Exactly.
Yeah, so it's a tough spot, I think, for many retirees. And I think having a financial advisor help guide them through all the different pushes and pulls of retirement, interest rates, and inflation is something that, every investor should explore.
Yeah, well said. Yeah, and with that, I just want to offer anybody who's on, whether you're a client or not of ours at Wealth Enhancement Group, if you'd like to spend a few minutes with us, whether it's to run a comprehensive cash flow analysis, to discuss your estate plan, to talk about your tax and distribution strategy if you have questions on your company benefits, or if you just want a second opinion on your portfolio and your current asset allocation. We're happy to spend a few minutes with you on a complimentary basis. The way to schedule a meeting with myself or one of my colleagues at Wealth Enhancement Group is just to call us at our home office at 800-900-5867. You can also send us an email at info@theretirementgroup.com with whatever questions you have, or to get in touch with one of our advisors, and we're happy to help you the best we can develop an investment strategy to pursue your financial freedom and independence whenever that is and whatever that means to you. So I think we're going to wrap it up for today. Thanks so much, Aya, for joining me. Those were some great insights. It is going to be probably an interesting year, to say the least, here in 2025. And hopefully we can help as many people as possible with their financial plans.
Thanks, Tyson.